when we talk about transition and what the role of banking sector is, bank is not a monolith. It comprises of different kinds of banks, and I think once you start thinking about these different kinds of banks, you will begin to think about what are the projects and where the funding will actually emerge. So it's not, I think it's not a mystery to anyone here that banking sector in India is actually one of the most important sources of finance. Whether you look at corporate sector, which will need to transition, which is to move to renewables, or the hard to abate sectors that we heard about. Even in terms of consumer lending, we do hear a lot about informal lending, but as the Indian economy itself begins to transition, a lot of people will rely on the banking sector. For many years, we know that there's been an experiment of tying national goals to the banking sector. How have we done that? We've done that through the priority sector leverage, right? And a lot of people will talk to you about, well, let's green the banking sector by putting priority sector green in the priority sector lending bucket. And what we've seen is that this kind of knowledge sort of caught up with the government, I think a few years ago, and which is why we have lending to the renewable sector as one of the categories to be considered under PSL. But what we've seen and experienced is the numbers that RBI gives to us is how much has actually gone there, right? So if you look at today, if you look at the total exposure of the banking sector to renewable energy is about 0.1%. This actually goes back to the original problem of what is profitable in the system. Where will finance readily move? Because as I said, banks will be traditionally conservative. When they give money out, they are absolutely sure about what is going to be the downside of having given this money. In fact, interestingly, RBI had a report last year. I think all of you should flip pages of that to know what banking sector developments have been. And what interestingly they have is a graph on NPAs within the energy sector. And if you look at that graph, don't want to be a pessimist here because I'm supposed to raise the ambition in the room. But what you see there is that NPAs even within the renewable sector have increased. And what we've seen with experiences of companies like Suzlon, for example, which have been quite volatile on the stock market, is that wind energy itself has its ups and downs, and so therefore there is that risk attached there. Having said that, I mentioned that you have the priority sector lending underdone. We also have noticed that overall in priority sector lending, banks have also tried to trade because they don't really meet the requirement of giving to priority sector, and so therefore they trade between them certificates. So you will see some banks are more exposed or have greater lending to the priority sector. So I think there needs to be some evenness there. But having said that, other than PSL, you can imagine the banking sector doing a little bit more. How do they do it? We all know that banks are required to invest in certain securities which are in a proportion to their deposits. It's called the statutory liquidity ratio, right? Now, this SLR is what? It is the green bonds, the government bonds that we know of. Indian bond market is a very interesting space. It's the government securities which dominate that market rather than corporates. And so therefore some of these a lot of these sit on the banking sector's balance sheets. Now one way to do it is, if you are anyway pushing your bonds to the banks, is to green these bonds, because they're going to be buyers for this. We've seen examples of the sovereign green bond issuance. There's a lot of optimism again there, but again on the greenium issue, right? It's the first issue, it's a small tranche, but as I imagine that the market will transition, will become more mature, you might just see that this greenium will disappear. Irrespective, the SLR is a policy instrument that is available within the banking sector to create this back and forth. So what SLR really does is create public finance space for projects that are considered aligned with transition. And so I think that helps identify some sources of finance where we know that private sector will not be absolutely willing to get in. I think that's one important part of the transition. Then let's talk about the other end of the spectrum. So we heard a lot about, we have to think about what would be the transition in, let's say, mobility, what would be the transition in power to the households, energy access to the houses, and I think linked to all of this is financial inclusion. What you have at the moment is some kind of germinating of ideas around creation of small fintech companies, which of course, if they have a lending operation, would be regulated by the RBI. And I think that's another model to look out and seek out for, because there is some thinking, of course, of profits, but at the same time to also think about financial inclusion, because it's all well and good to say we're going to change the way our power sector operates, but who's going to access this? Because you need, at the very end of the consumer, the ability to access this source of power. So I think that's another important piece of the puzzle. Another interesting development, which I think from the banking sector perspective is quite important, is that there have been banks that come from abroad and operate in India as branches. And they, for example, have very different mandates. So if you talk to, let's say, a Standard Chartered, they have their mandates being set in the UK, where there is stringency on who they lend to and how they lend. And in fact, they actively desist from lending to fossil fuel-based sectors. So you would see that they would have an implicit way of saying we don't lend to coal at all. So what you're seeing there is that these banks, with the support of their parent entities, are able to sustain a profitable business, even though small, in India by having these filters on how they lend. Now what's happening is that Indian banks are now in the phase of exploring what this kind of a business model would mean for them. When we think about the banking sector in India, we tend to think of it as SBI, HDFC, which are the large banks, but that's not true. So we have a lot of other banks, we have local banks, and the capacity development at all these levels of banks is very different. So for example, if you did expect an HDFC to follow the model of, let's say, a Standard Chartered, might be slightly easier, but all other banks find it difficult because there's not enough understanding on which sector is aligned with transition and how much needs to be done. Now, RBI has moved a step forward again. Do read the report on currency and finance. It talks about global practices. There is at the moment TCFD, which is a form of disclosures at the bank level where it evaluates its portfolio. The RBI has announced that it will think of how to regulate and suggest to banks to disclose this information. I think there are two facets of this which are absolutely critical if we are going to say that bank is going to be aligned to our transition plans. One is that they will have to know how to disclose this information, right? So imagine having to go and speak to all the companies that you lend to, as well as there is consortium lending in India, which is that bunch of banks come together to lend. Now, let's say you are the weakest bank in there. You need to push that you have equal information and you have equal capacity. I think the second is also how do you use this information? I mean, one is that you just collect it, and in India we have great joy in collecting a lot of data, but how do you actually process it and use it to your advantage to know where the risks are? And I think that again is linked back to capacity building, and over the next few years we will learn to live with something called the stress tests. So if you look at RBI's reports, they've done a very high level assessment of the banking sector's exposure today. So linked to all of your transition is, it's not just about you got to lend to green. It also means that all of us have our money in banks, and these banks have lent it forward to sectors which will transition. Now imagine if everyone starts saying you got to divest. It's kind of a spiral that you are stuck in then, and the bank's profitability is hit. So there is an issue of stranded assets as well, which means that banks need to also prepare for this particular transition, have to strategically think of what resource base they have, and from the information that's disclosed to them, be forward-looking. But for this, there needs to be a high-level thinking, and I think that was a previous session we were talking about. There should be a decarbonization plan, and there should be a strategy, and you link it back to what the banking sector must do. So RBI has done some thinking, and again, they have done a modeling exercise where they look at scenarios of 2070 net zero. If you look at that report, it's rather grim, because 2070 does not give you emission reduction to the extent you want to be able to meet your Paris Agreement goals. But if you do a 2050, you need all kinds of levers. So we heard about the carbon tax as well. So one other method of pushing everybody is to make them pay a price for emitting. And that, again, has backward linkages to our GDP. It'll have a backward linkage to our inflation. And what that does is then it also has effect across the banking sector, because the ability of people to borrow, the cost of borrowing, all of that will change. So just to bring this all together, I think there has to be very top thinking, which is to have like a national strategy, which the RBI also clearly says is not its mandate. From there, it'll pour into thinking about what it means for banking sector. Within the banking sector, it'll mean very different thing for very different banks. So for the smaller banks, it would be also a need to survive and to adapt. For the large banks, it would be a screening process, which some of them have in a way. And I think at the very local level, there would be the dual challenge of resource constraint as well as supporting those who are affected by transition. I think the very last bit is to say that, as I said at the beginning, banks are not a monolith. You also have development banks. So now what we've seen, at least with the climate conversation, we have suddenly woken up to all the development finance institutions that were created, spread across states. And I think they can play an important role, but again, that means that there needs to be strengthening of public finance, which will fund these institutions. You have multilateral banks, which again are being requested at different fora to sort of support. But I think despite all the narrative around how we could scale up their existing forms of capital, I think we still need to reimagine some kind of conventional institutions which are domestically located than to have to say that a World Bank or an ADB will do this, primarily because the money comes from shareholders who are going to define the terms of lending out. In fact, very interestingly, if you look at the MDB report, which spans all kinds of finance that has been put out in the market, you will see differential rates of interest across countries, as well as all of this sort of coming through as loans. So if we are imagining the development banks to play a new kind of role, you also have to, I think, reimagine institutions. Otherwise, they remain pretty similar to our conventional banks, and with limits on perhaps some kind of a discount on lending. But I'll just stop there, saying that, that I think what needs to be done is also think about how banks will imagine funding technology, which is also at the riskier end of things. But I see that technology is key for this transition. So I'll stop there. Thank you so much.